Viewers, and welcome to the channel. In this week's video I'll be discussing how WiseTech defied expectations to rally 30% on its full year results. WiseTech's a stock that's fortunately in one of Rivkin's strategies, the value strategy. It's a stock that we've held at times, plenty of times actually in the past, and one I'm personally a big fan on. It was great to see them capitalize on what I thought is a perfect environment, and to actually see them deliver on those that promise with its results was quite rewarding. Anyway, just as per usual, the chart of WiseTech over the last couple of years since the beginning of 2020, which factors in this downturn as COVID hit, where the stock actually went to a little over $10, which was pretty incredible in hindsight, especially as we now know how important e-commerce became in everyone's lives, and certainly in those early days of the pandemic, that was very hard to see, with fears that economies would collapse. This was obviously, at least in those early days, before we knew how governments would spend to stimulate economies as much as they ended up doing. And we've seen a steady increase, and then of course, as they announced yesterday, the stock pops pretty significantly. It was up almost 60% on the day, which I think was a lot of short covering. It's not a particularly liquid stock because the founder owns a good chunk of it, I think 40+% of it, but ultimately ended up about 30% on the day. Anyway, I've got some slides here from within its roles which really demonstrate the strength of the business right now. So, anecdotally, at least in the middle of reporting season, one thing we're seeing companies talk about is supply chain stress. I have an involvement with a skincare manufacturer, and talking to the CEO the other day, one of the things he said is that how much their shipping costs have increased. Typically they would be spending. Most of their shipping would be done by air freight, but with passenger flights now mostly grounded, and obviously a lot of its shipments going through, in the belly of those planes, have now had to look for alternatives, and part of that has been through actual shipping, which is both more expensive and significantly slower. And so there's all these, and that's not just them. We've seen this across many companies talk about both the inflation they're seeing from supply chain issues, but delays as well. But all of this kind of spoke to the incredible pressure the logistics world is probably under at the moment, and such incredible demand as well. As I've said, populations have been provided government stimulus and have had to had forced savings, and of course partly scratching that itch with spending on e-commerce, and so undoubtedly we've seen huge amounts of spending in e-commerce, which has led to logistics companies and freight forwarding companies seeing incredible demand, and this is probably both excellent for the existing client base of WiseTech, but also great catalyst for change for those that are still relying on kind of legacy dinosaur systems, and moving to cloud-based systems with real-time feedback is, I think, clearly the way forward. And while WiseTech has been growing very quickly, could mean that its future growth could be even more impressive, and the land grab is on, and at least given the client base that they have and the customer wins they have, it very much feels like these guys are the best in class. The retention rate they have from their clients is huge, and of course it's a big move for a company to actually move onto CargoWise platform, which is WiseTech's platform, and then obviously change their mind. But for the most part, that retention rate, the attrition rate, is really supportive. That is, the best product out there. Anyway, exceeded all kind of earlier guidance. Kind of begs the question, why didn't they provide earlier profit upgrade? But they didn't, and that kind of helped with the pop yesterday. But excluding foreign exchange movements, which for at least that financial year were a negative, but in this financial year so far would be a positive. And we saw a 24% increase in revenue. Recurring revenue is up 90%. Sorry, it is 90%. I won't go in here because there is some acquisition revenue here as well, but this is an important thing as well. You know, WiseTech was always a company that was kind of priced on its revenue, and you know, always deemed by most analysts out there as, you know, impossible to value on a profit multiple, and you know, you can now start to see that this is becoming a more mature business as its acquisition strategy has finally matured, which is probably matured in part because of, you know, the nasty incident it had with that short seller a few years ago in JCap, which criticized it and said it was using, you know, what I would say is, you know, the accusation was for fraudulent accounting, but they've combated that by saying, well, you know, we built scale, we did exactly what we wanted to do, and now we're mature with that strategy, and now we want to integrate these acquisitions and grow organically from here. And the, you know, the early runs on the board suggest that strategy, that acquisition strategy, was spot on, because we're now seeing it flow through to the numbers, and you know, and this number here really shows the, you know, scalability of these software companies and why they do get that premium multiple from the market, and shows that, you know, an increase in revenue by 24% flows through to an increase of to 63% at the EBITDA level. You know, now it's making, you know, $200+ million in EBITDA, which is pretty incredible considering, you know, a few years ago it was still running losses. And you know, all these other numbers, they're paying a dividend, but who cares? I think that's just kind of lip service to show that they are making a profit and can afford it. But you know, for the most part, these guys should be spending on growing the revenue line as much as possible, which, you know, for the most part they are doing. This is, you know, all these underlying tailwinds I talked about. You know, global trade continues to be very strong with, you know, supply chain bottlenecks and increased freight rates. Structural changes, as I mentioned, this is replacement of these legacy systems, and this is, I think, clearly a catalyst for that to accelerate. And you know what these guys, you know, the best part about it is, of course, the penetration. They're continuing to win the best customers. The revenue from these customers grows over time as well. So bringing on new customers isn't all they need to continue to grow revenues and profits, but also they are getting those increased revenues from the existing client base. But you know, the blue chip names they're winning with post end of financial year signing of FedEx, which is obviously one of the biggest freight forwarders in the world, and you know, I think clearly many more years of strong growth to come. And this, you know, pointing to that, this is the guidance for FY22. A revenue growth of 30 to 40%, which excludes FX. So probably, assuming the currency remains, the Aussie dollar currency remains depressed, that'll be even greater. No new acquisitions, it seems they're talking about, which is, I guess, good, but you know, almost to some degree. Once they've won back the market's trust, they may start to look at some acquisitions in the future again. And this was the other part as well. You know, this is beautiful. They actually ended up reducing costs significantly above what earlier guidance had been, which again, you know, I think a few years ago the market wouldn't have thought that would be a possibility. And again, also we're seeing predictions of significantly higher EBITDA margins for FY22. Again, showing, you know, the more money this company brings in at the revenue line, the more it's going to flow through to the EBITDA line and NPAT line. Shows the beautiful scalability of a software business like WiseTech. Anyway, if it wasn't clear how excited I am about this business, I should reiterate that it is a, you know, incredibly high quality business exposed to amazing, you know, long-term tailwinds. It's not cheap by any stretch of the imagination. It certainly isn't necessarily going to go up in a straight line. But you know, if we come back to talk about this in 2, 3, 4, 5 years, I won't be surprised if this company is significantly higher, and certainly its revenues, I think, will be significantly higher, and that should be reflected in a higher share price. Anyway, thank you very much for tuning in. If you like the video, click like and subscribe, and I will be back to you next week.